So last time we talked about things like analyzing a company's financial statements. In doing so, a lot of analysts will actually do what's called a pro forma analysis. They will actually project forward using some assumptions about how the company is operating. What does their growth rate of revenue look like? What are the assumptions around their costs of goods sold? Are there any assumptions around selling, general, and administrative costs, depreciation and amortization? And sometimes it'll even be very detailed. What bonds do they have coming due? What loans do they have coming due? And when are they going to need to refinance them based on their current projections of revenues and costs? And so in doing that, they can create essentially a forecast, and they can do, an up scenario and a down scenario in addition to their baseline of how the company's financial statements are likely to unfold for 2, 3, 4, even 5 years. As you might expect, it's very time consuming, it's very difficult, and it's also prone to a lot of error. There's a lot of judgment involved. So it can be a little bit daunting to undertake. I forgot to put in problem sets questions, but I will fix that and repost this to Canvas, and I'll announce that when I do. So after an analyst has done all that, they can actually start the process of actually valuing a company. And so we'll talk a little bit first about valuations and market price. There are differences between the two. We'll talk about a few valuation techniques. And then lastly, we'll talk about the enterprise value, free cash flow to the firm, which we went through last time. And it is something that I think is beneficial for you to know how to calculate. And also talk about stakeholders of the enterprise value. All right, so valuations and market price. So it is very easy in today's world to actually get access to publicly traded companies' financial statements. Their SEC filings have never been, they've been extremely easy to get for many years. There have been lots of improvements to make them much more viewer accessible in web browsers. You still have to do quite a bit of work. A lot of companies still in their filings, even their 10Ks, which are the annual filings, they still only show usually 2, maybe 3 years worth of data for each of their financial statements. So it can be a little bit annoying to have to go and pull 5 different financial statements, 5 different 10K filings. While it's easy to get access to the data, it is important to understand that these filings are reporting essentially the acquisition cost of assets when you're looking at balance sheet. And so there's a big difference between what you're seeing in the financial reports and what you would define as the value of the company. And again, even another difference, discrepancy between the value that you might ascribe to that company and the market pricing of that company. So there are lots of differences. A lot of professional researchers that publish reports on a periodic basis really focus on just using price metrics. What's the P/E ratio, price to earnings ratio? So all they have to do is say, well, what do we expect earnings to be the next year? How many shares outstanding are there currently? And they call them weighted average diluted shares, meaning if all of the warrants and options that are out there in existence were immediately converted to common, how many shares would that mean? You can get an earnings per share. Or sorry, you can get a number of shares, and then you can get an earnings per share, and then use the P/E ratio that you want to use, and now you have your price. That's a market price metric. So it's based on, well, what are the other companies that are similar to the company we're doing a research report on, and use those average PE ratios there. Also look at the company's historical PE ratio. What does that tell you that you should be using? One that is a very popular one for people who are a little more value investors, PEG ratio, price to earnings divided by the growth rate. So if the price to earnings is 5, and it's expected that earnings in the companies are going to grow by 5% for the foreseeable future, that's a PEG ratio of 1. And generally, it's best to have, it's more attractive to have a PEG, a PEG ratio, that's below 1. Price to book. Also price to tangible book. If a company has a lot of goodwill on their balance sheet, like some companies do, I'm thinking of Salesforce as an example, you may want to remove those intangible assets. So goodwill, patents is an intangible asset. Remove those from the book value of the company. Again, turn it into book value per share. And now you have a price to book ratio by looking at market price. So if you're able to do a pro forma analysis of a company and actually project forward, what is their book value going to be 1 year from today? What should be the proper price to book ratio we should use to figure out the market price? That's it. These are very, seemingly almost too easy. Obviously, I think they kind of are, but still they are used over and over again. They're also used, price to earnings is also used as a way to gauge whether or not the market is kind of overpricing certain stocks. So it's also something to keep in mind. Some very, very good analysts, good research analysts, might actually try and figure out what's the liquidation value of the company. Now that takes a lot of work. Essentially, if the company were to be taken to bankruptcy proceedings and they had to liquidate the company, what would the actual assets, like the business units or the actual hard assets, be worth? So that takes a lot of work to actually figure all of that out. But it is something that some analysts do. Tobin's Q. The ratio of the market price to the replacement cost of assets. So if we were to replace all the assets, less the liabilities. So that's essentially the equity stakeholders portion of the replacement cost of assets. And you take that ratio, that can give you a value of a company. That can give you kind of an idea. Okay, well, what should we be using? Now again, book value that you see on financial statements, those are the acquisition costs. They are not the replacement costs or the replacement value. So adjustments need to be made. And this shouldn't come as a surprise. Working through all of the adjustments that need to be made is very time consuming and takes a lot of work. Those research analysts typically know a great deal about the company. A couple others that are used, price to cash flows. And you can use free cash flow to equity, which is probably the best to use. So you remove out the portion that the debt holders would essentially would be their portion. So you use probably net income plus, as opposed to adding back in interest, you add in depreciation and amortization and skip adding back interest expense. And some of these are vary by industry. So you may find that some industry analysts really like to use price to cash flow for, let's say a high capital intensive business. Whereas in retail businesses, they might prefer to use price over sales. Sales is a very broad measure. So trying to get sales per share and then take the price divided by sales per share, you're going to get a very small number with that one. Now, in the textbook, Boddican and Marcus use these terms a lot. The intrinsic value. That is the value of future cash flows, the present value of future cash flows, discounted by the required rate of return. To me, I would call that enterprise value. So that required rate of return, that's an important thing to figure out. That's the market capitalization rate, is the market consensus for the discount rate to use for future cash flows specifically tied to equity. So the equity cost of capital. And usually the way that the market cap rate or the required rate of return or the equity cost of capital, which to me are all the same thing, the way that you get that estimated is you use a CAPM model. There's no other way to do it. And so these terms are important because it's also things that we're going to actually calculate. We're going to do that today. Any questions about some of those concepts before we move on? Valuations and market price. Using those price ratios and price metrics in a very, I'd say crude sometimes, way to just quickly get to a market price target. All right, let's talk about some valuation techniques. Before we delve into the first few, I am going to walk through a few steps of an infinite sum series. And this may seem a little bit odd because this isn't a calculus class, but I think it's helpful to understand where these ratios come from. So first of all, what we have here, I didn't put it on the graph here or on the page here. We have a growth rate G, and we have a cost of capital K. A few things that you need to know ahead of time. Growth rate is greater than 0 and less than the cost of capital. Cost of capital is less than 1. That's an important assumption to make. Otherwise, this doesn't work. When you see the final formula, you'll probably know why. I do not think that Boddican and Marcus have this. I'm fairly certain they don't have this in chapter 13, but it's one that I think in terms of if you want to value a company without using market pricing metrics, this is the way that it works. So there's that first equation up at the top. I simply copied it below, but this next step is a little bit tricky. And you might be thinking that I'm a little bit off my rocker when I do this, but there's a reason. I am effectively multiplying this whole thing by 1, except it's a fraction. It's represented in a fraction form. 1, I've got that problem with my cursor again. In the numerator is 1 minus the ratio of 1 plus G over 1 plus K. in the denominator is the exact same thing. B over B is equal to 1. 1 minus 1 plus G over 1 plus K divided by 1 minus 1 plus G over 1 plus K is equal to 1. So why did I do that? Well, I'm going to distribute the numerator portion, 1 minus 1 plus G over 1 plus K, into the summation series. That's just a property of mathematics. I believe it's called the distributive property. So you see that I've just moved it into the summation. There's nothing wrong with doing that. In the denominator, 1 is the same thing as 1 plus K over 1 plus K. So I've moved that 1 into the parentheses here. 1 plus K minus 1 minus G. Okay, all I have done is rearrange in that line. Now comes the fun part. There we go. If I go back, oh, that's why it's not working. So from this line, this bottom line to the next slide, I've simply moved, I'm going to move this 1 plus K into the numerator because 1 over a fraction is just inverting the fraction. It's a reciprocal. I'm also going to eliminate 1 minus 1, that's 0. And so what I'm left with is 1 plus K, I just moved that 1 plus K to the top, divided by K minus G. And that's all I've done in this slide here. I go back, that's all I've done. Now I have to try and tackle that summation. And that's where it'll get a little bit difficult. Any questions here? Because if I need to go back and re-explain steps that I've gone through, it's better to do it now before I talk about this part here, what's under the summation right now. Okay, well then I'm going to move ahead. All right, so now all I've done here, I changed that 1. I distribute the 1 plus G over 1 plus K to the power T inside the parentheses. So now I have distributed that times 1, so up here, that 1 minus 1 plus G over 1 plus K. So 1 plus G to the power T over 1 plus K to the power T minus 1 plus G times 1 plus G to the power T. That's simply 1 plus G to the power T plus 1. And then the same thing in the denominator. I have 1 plus K times 1 plus K to the power T. That is simply 1 plus K to the power T plus 1. I've just distributed that ratio, that fraction of 1 plus G to the power T over 1 plus K to the power T inside the parentheses. Okay. Now this step, all I did was I can distribute, because these are two terms that are subtracted from each other, I can represent them as separate summation notations. That's all I've done in this example here. And if you look closely, I can actually move it around a little bit more. I've got this t plus 1 there and t plus 1 there, and it starts from t equals 1. So this is simply starting at 1 plus g squared over 1 plus k squared, and then adding onto it that series, well, 1 plus g cubed over 1 plus k cubed, next term 1 plus g to the 4th over 1 plus k to the 4th, on to infinity. And so what I can do is I can actually, again, more shenanigans, change that t subscript to just plain t. Instead of starting at 1, I start at 2. Now what I have is the series that starts at t equals 1 going on to infinity, minus itself, except it starts at 2 and goes on to infinity. Thus, the only thing that's left is 1 plus g to the power 1 over 1 plus k to the power 1. It's the only thing that's left. That's all that remains. And on top of that, 1 plus k divided by 1 plus k, I'm left with the simple ratio of 1 plus g all over k minus g. And again, this only works if g is less than k. Otherwise, the summation series here does not converge to a value. If the ratio of 1 plus g over 1 plus k is greater than 1, this will explode. It has no limit. It's unbounded. It goes on to itself. It goes on to infinity. So it only works if g is less than k. All right. Does anyone have questions? Is anyone curious why I even bothered to do this? Which is fine if you are. I will not expect that you can recreate this proof. This is a proof of why this equation works, of why this equation holds. But I think understanding how these summation notations work make it easier than me just telling you, memorize this formula here at the end. 1 plus g divided by k minus g. I don't think that's as beneficial. So why did I just spend 5 to 10 minutes going through all that? Why did I just expend all that energy making all of those slides and talk you through that? Because that's the way that they came up with the formula for the dividend discount model. And so for the dividend discount model, here's an example. And just in fair disclosure, I don't think the dividend discount model is a good model for valuing companies at common shares, just generally speaking. It's usually very far off. So let's say a firm paid dividends in the past year, and those dividends were $4 for the year. And last year is denoted with a subscript T in the equations to come. Their sustainable growth rate of dividends is 4%. Cost of equity capital, or the required rate of return, is 11%. What is the intrinsic value of the common equity share price? Well, if we consider holding that firm's common shares forever, that means that we are going to get cash flows from holding those shares forever. We will be getting dividend payments. So we hold it today, we buy it today. We get dividends in the year T plus 1, so that's the coming year. The subsequent year, oh, and there's a, that's correct. Subsequent year, no, it isn't correct. So I have to fix that. There we go. Now it's correct. To the power 1, to the power 2, to the power 3. So discounting by their cost of capital. That would be the intrinsic value of the company. Now, Bodie, and Marcus spent a lot of time in the textbook talking about, well, what if we have these different growth rates of projects and these different cost of capital rates? I don't know how beneficial I think those are in terms of real practice, because that's not really how investors or analysts actually research companies. So this, I'll have to fix this as well. There we go. If we're assuming that their dividends grow at a constant 4% per year, and their dividends in the past year were $4, it's a very simple exercise to actually essentially plug in that formula that we just derived. We have dividend from the past year times 1 plus the growth rate. That's the dividend that will be paid in 1 year's time. Multiply by 1 plus the growth rate again. So 1 plus G squared. That's the dividend that will be paid in 2 years' time. And it goes on forever. And this is the exact problem, the exact formula that I was working on in those last few slides. And so if you simply plug everything in, it's a very straightforward exercise. So for this company with the $4 dividend that it just paid over the past year, growth rate of dividends of 4%, 4 times 1.04 divided by cost of capital is 11. That's the equity cost of capital, or required rate of return for equity, minus the growth rate of 4%. You come up with a price of $59.43. That's a pretty nice dividend yield. It's a 6.7% dividend yield. It's kind of nice. I'd take that. If that, in fact, is the price. Now, there are some shenanigans that can go on. There are, the growth rate of dividends should be equal to, and again, Bodie and Marcus do this in the book, return on equity times what they call the earnings retention ratio, which is 1 minus the dividend payout ratio. What's the percentage of profit that the company keeps in retained earnings and does not pay out in dividends to shareholders? And so because of this relationship, you can actually use, some information to go between the growth rate and the return on equity. This is sometimes called the sustainable growth rate for a company's dividends. So this is talking about a dividend discount model. What if a company has a series of dividend payments that are growing potentially faster than they should, or maybe they're growing slower than they should? The dividend discount model would then suggest that you should calculate the present value of all of those dividend cash flows until the point at which the company returns to a more stable and sustainable growth rate of dividends. That would be L years into the future. Again, that ratio 1 plus G over K minus G, that's just tied to the fact that we're using this infinite sum series, where we have a constant growth rate for the remainder of, or I guess for on to infinity. Would you normally be given the payout ratio? Yes. So questions would be, let's go back up. So you would have to be given enough information that you could work through this problem. So it could be something to the effect of, what is the payout ratio if ROE is X? Or what is the sustainable growth rate of dividends if the firm's return on equity is 15% and their payout ratio is 25%? So quick check, what would B equal in that case? Payout ratio is 25%. What's B? So B is 1 minus the payout ratio. It would be 75%. Okay. Any questions about those valuation approaches using dividend discount model, the relationship between ROE and the sustainable growth rate and the dividend payout ratio and the earnings retention ratio? All right, so now we come to the part where these are the types of techniques that value investors would use to value a company. The most famously, Berkshire Hathaway, Warren Buffett's company. The way that he approaches valuing a company is looking at their cash flows, figuring out who are all the other stakeholders. So first of all, we have to talk about enterprise value. Enterprise value is the total value of the company. And it can be broken up into 3 distinct parts. The equity shareholders. And if there is preferred equity, you have to incorporate that from the balance sheet data. So I'll amend these slides to reflect that. So equity stakeholders. Net debt, book value of debt less cash and equivalents. Net debt. And if you recall free cash flows to the firm, I had you remove cash and equivalents from current assets when you were calculating working capital. That's because it's going to be immediately assumed that the debt holders get access to that first. Last term here is minority interest. Now, the useful thing about debt and fixed income and minority interest and preferred shares is that they are very clearly defined and valued on the balance sheet. And it's a conservative value. So it's better to take those than to say, take the market value of any of them. So those can easily be just put onto this slide. But the one thing that isn't as easy to ascribe a value to is the common equity shareholders. What is their actual value? What's their portion? They are the remainder. They are the equity stake. They are everything that's left over is owned by the common equity shareholders. And so let's do an example of Tesla, just for fun. And I took this from their 2020 fiscal year 10K filing, their 12-month period ending December 31st of 2020. They have no preferred shares, so I do not have to subtract preferred shares, but they do have book value of debt, and that's listed on their financial statements, and they have cash and equivalents, which, by the way, that has surged in the recent year. So book value of debt, I took 9,000, or it's actually 9,556 million, plus the current portion, 2.132, which probably we could take that out because it's accounted for in working capital, but minus 19 billion, that's the cash and equivalents that they have. So their net debt is negative. And that's sometimes difficult to comprehend. But if you were to think about it, if Tesla were to file for bankruptcy tomorrow, they have a substantial portion of debt sitting in their coffers, substantial portion of cash sitting in their coffers, such that they would simply just give that cash to the debt holders and say, we'll figure out the rest from here. They do have some minority interest on their balance sheet. And I think on subsequent slides, this is going to be fixed because that is, when I looked in some of the more detailed notes, it was actually higher than that. So that's my mistake. I'll fix that again. Another item. Whatever remains will be the stake of the equity shareholders. So it's really weird. Equity stake, the enterprise value is equal to the equity stake minus 7.7 billion plus 850 million. Well, how do we determine that equity stake? Another useful tool is that the enterprise value of a firm should also be equal to the present value of the free cash flows to the firm. And so for this, we have free cash flows to the firm at time t, discounted by 1 plus r to the power t. And we go from 1, so 1 year ahead, to forever, infinity. We simply equate those two sides. And then we solve for the equity stake. So we have net debt from the balance sheet data. We have minority interest from the balance sheet data. We have free cash flows to the firm that we can calculate using our tools. And this is where it gets difficult. You, as an analyst, would likely be tasked with doing some pro forma analysis. That's taking all of the line items on the major line items on the income statement and the balance sheet. I typically, historically, personally just did key portions of the cash flow statement and projected them forward using some rules, some relationships. What are their operating margins? What are their gross margins? Are there any special circumstances that need to be considered? Are there any lawsuits pending that are likely to impact their profits? Then after a few periods, typically most analysts, after 3, maybe 4, the more rigorous ones might go out to 5 years, they assume that cash flows, free cash flows to the firm, grow at a constant rate. And here we have that hopefully familiar by now equation. Which you would know immediately, oh, that's just going to be FCF at 0 times 1 plus G divided by R or K minus G. This formula comes up a lot. So now here we have equity stake is equal to free cash flows to the firm. That's times 0. That just simply means from the prior period, so the prior year, times, if we assume a constant growth rate, 1 plus G divided by R minus G, minus net debt, minus minority interest. The equity stake, if it has preferred shares, you would have to, see if I can do this really quick. If there are preferred shares, you subtract preferred equity as well. Because again, preferred shares behave much more like bonds than they do like stocks. They're just more like perpetuity bonds. They are around forever. An alternative technique to using what some people call the multiple, that 1 plus G divided by K minus G or R minus G, is to use an enterprise value to EBITDA multiple. And this is far more common when the analyst is assuming there's going to be a future buyout. And so they might come up with that multiple represented by the letter M in the equation below, and just do free cash flow from the pro forma analysis for the next 5 years, and then figure out what's that multiple that we should use. Again, we discount by 1 plus R to the power 5. And so, of course, I wouldn't just do this without showing you some work. So let's take this from the perspective of free cash flow analysis. And if you want to modify these numbers, just let me know and I can do that. But I've calculated, this is Tesla's information, 2014 to 2020 is actual data that I took from their financial statements. I did not do a full pro forma analysis, so I'm just essentially kind of guessing how much debt they might need. How much debt financing? But when you see a blue number, those are numbers that I typed in. And I got this net income from kind of the street consensus forecast. I think theirs is actually a little bit more aggressive than that, but I wanted to be more cautious. And then from there on, I assume a 10% growth rate in net income, just to simplify it. So I have cash and equivalents, I have it going down. Current liabilities growing at 10%. Current portion of long-term debt of 1.5 billion, growing at 10%, which is not the way you would want to do it if you were really, truly trying to value it. They have listed out all of their debt and the maturity of that debt, so you can get a better sense for what their actual current portion of long-term debt will be. And then shareholders' equity. I simply, so I add 1,500. If you go to their financial statements, let me pull them up really quickly. Here we are. And again, this is from the SEC's website. You can get all of this information. APIC, additional paid-in capital, right here. Going up by a fairly large amount. So they are selling some shares, some treasury shares. Here. 1/10 of 1 cent par value. And their share price is what, 650-ish? It's between 600 and 700 the last few days, unless it's changed significantly. I haven't checked it today. So they'll sell them to generate some capital, some equity financing. And so there is a 1,500 plug that I'm putting in there for APIC, additional paid-in capital. And then the retained earnings, they get to keep net income less the minority interest shares. They only get to keep net income times 22,255 divided by the sum of shareholders' equity and minority interest. So their shareholders' equity will grow by that much. And because I'm not exactly sure of that minority interest, it might be a joint venture in China, which is how you have to do business in China. And so that might arguably be an underestimate. Capital expenditures. They spend a lot of money on purchasing machinery that actually produces their automobiles, their electric vehicles. They also have a peculiar CapEx component. Let me go look it up, because I'd never come across this before. And I'm sorry that the font is so small, but they do this. Sometimes I wonder if they do this on purpose. Investing activities. Purchases of solar and energy. That caught my attention. And that seems like it's something that they're going to have to do on a going basis, and that is part of CapEx. So I said, well, that should be included. And that's the way I did it. See, that was balance sheet, statement. This is from their most current, just to give a sense. Purchases of solar energy, right there. No, there we are. So I just made the simplifying assumption that's something that they would have to do on an ongoing basis, and so I included it as part of CapEx. Have CapEx grow by 10% every year. That's a cash flow, not an expense. Again, simplifying assumption, have depreciation and amortization grow by 10% every year. And then just like I had you calculate free cash flows to the firm, I did it myself for Tesla. So I take net income add back in the interest expense. Interest expense is expressed as a negative number, so I put a minus sign. Add back in the depreciation and amortization to J15. Incorporate capital expenditures. It is expressed as a negative number, so I add it. So you have to make sure that the signs are in the correct direction based on how they're presented in your data. And then I subtract the change in working capital. Working capital is current assets less cash, less current liabilities, minus the prior period's non-cash working capital. And so that's a formula. It's a formula that I have in all of this. So from 2015, 16, not surprisingly, they had negative free cash flows to the firm. And lo and behold, all of a sudden, now they have positive. Based on the projections that a lot of market analysts have for net income, which are very aggressive, I thought, well, let's just put in a 3.2 million plug and a 5.3 million plug for 2022, and then have them grow at 10% from there on out. This is per year. This is per year. And I think that's pretty conservative. Here, these lines are figuring out, well, what's the portion of debt and equity on the balance sheet? Here's the WACC, weighted average cost of capital. Here are the costs of capital, 1.6% for debt after tax, 14.5% for equity. So the weighted average cost of capital, which is our discount factor, our discount rate, for free cash flows to the firm. And now we have everything we need. This is a very crude model to value Tesla. And it's a formula that takes into account, well, we have to discount by the WACC, weighted average cost of capital. And it's raised to the power of however many years into the future we're looking. So that's O2 minus I2. 2026 minus 2020, that's 6 years ahead of time. 6 years from now, roughly. And then at the very, very end, I take free cash flow to the firm, divide it by K, 12.31%, minus G, my growth rate, which is 10%. And that's what I use for my enterprise value. I have to discount that because that's the value 6 years from now. And so I discount it using that 1 plus the weighted average cost of capital to the power 6. You take the sum of all of these discounted values, you get the enterprise value today, figure out the net debt, figure out minority interest. Everything that remains is equity. There are no preferred shares, so it's all common shares, 770 million common shares. That gets me to a share price of $300. This is a very laborious way and time-consuming way to find a value for a company. But it gives you a sense of, well, if you were to try and price this without knowing anything about the current market price of the stock, but you were given, fortunately, the equity cost of capital, how would you price the shares? And so it gives you that ability to do it. And it's very difficult to just kind of go through and say, okay, how do we get free cash flow to the firm? It takes time to get used to that. and trying to understand why we add back interest expense. Well, that's because the enterprise value, the debt holders are one of the stakeholders of the firm's enterprise value. Why do we add back depreciation and amortization? Because it's not a cash flow, it's a non-cash charge. Why do we incorporate CapEx? Those are the actual cash flows tied to managing the business by buying capital products. Why do we use non-cash current assets, non-cash working capital? Well, because we incorporate the cash in the net debt calculation. So if you wanted to figure out the EBITDA version, let's say it's a 15 multiple, so EV, EBITDA, what's EBITDA? So this, let's use a 15 multiple. EBITDA would be equal to, well, very crudely, let's just do, I don't have tax here. What is their tax rate? Let's just assume they have an effective tax rate, 1 minus point. Let's say that we have to divide it by that. That gives us our pre-tax earnings, assuming a tax rate of 25%. Add back in depreciation and amortization. Add back in the interest expense. It's expressed as a negative, so I need to subtract. Whoops, times. So it's a little bit higher of a value. So if we do that this way, cost of capital, I said to the power 6. Let's go ahead and do it here. I don't know if 15 is the proper EV/EBITDA value to use. I also don't know that I really trust my projection of EBITDA or my projections on this very crude pro forma analysis. But this is how you get there. You get to free cash flows to the firm. I'm not expecting that you would do this in an exam setting. In a graduate level class, I would probably have you write a report, a research report, where you did have to do this, which means I would have to teach this portion earlier in the semester. But this gives you a glimpse as to how it is done. Whether you're using the perpetuity free cash flow model or the EBITDA multiple, exit multiple, you are making some assumptions about what should that valuation be, what should the EBITDA multiple be. You're making lots of assumptions to get the free cash flows of the firm, and then finally getting to the EBITDA and that final point, and lots of assumptions about what the growth rate should be. If we changed our growth rate, where's our growth rate? Our growth rate cannot be above 12.31%. And it's very dangerous to change your growth rate to be even close to 12.31%. Because remember, that's the growth rate forever. Now, granted, you might say, well, I think that they're going to be able to grow by 20%, their bottom line. Notice what that did. So let me actually put this as 10%. What if we made that 20% net income growth for those years? And it got up to 10.9 billion. What if it was even more exponential? Let's say it was, eventually got up to like 20-some billion, which would be quite a feat. I still am only getting a price with a 10% perpetuity growth rate forever. I'm only getting a price of $465.72. Maybe I've got some problems in my model here. Maybe I should make these 8 billion, 14 billion, 18 billion. There we go, 23.6 billion. Now we're getting closer to the current market price. Playing around with these gives you a sense of, okay, what do I need to have happen really to justify what the current market price is? That's all I had prepared for today because this is a lot. And I'm expecting that you're probably going to want to or have to watch the recording again. But I look back at when I was sitting in your seat taking an investments class, and I saw this and I thought that actually is really a really fascinating way to approach valuing a company. So, long and the short, you're not going to have to do pro forma analysis on the exam. It takes too long, and I would not be able to give you partial credit. And it's something that I think you should earn partial credit for. Just because you miss one or two numbers here or there, I would be able to see that. But if you're given some financial statement data on a company, I would expect that you would be able to calculate free cash flows to the firm with that data. If I were to give you free cash flows for a company for the next 4 or 5 years with their weighted average cost of capital, or with their cost of debt capital after tax, cost of equity capital, and the weight and how much debt and equity financing they have, and give you an assumed growth rate, the perpetuity growth rate, I would expect that you would be able to get to an enterprise value of the company, and given the number of shares outstanding, you can come up with a share price yourself. Now, I said that the dividend discount model I'm not a big fan of. I just don't think it's accurate. That's not to say that it's not useful. And so let me go back to it really quickly, highlight that. Here we are. So if you follow market reactions to, say, economic data that comes out or a central bank action or press release, and you're trying to figure out, well, what is the market's reaction and why? This formula provides some insight. The cost of capital is going to be directly influenced by central banks changing interest rates. The growth rate will be impacted by real economic growth as well as changes in inflation. And so when equity markets respond to to events, whether it's economic data releases or central bank press releases or speeches, you can use this equation to infer, okay, which problem or which issue is really what's driving the market prices to change. Is it risk-free rates going down or expected growth rates going down, which would have opposite effects? If nothing's going to happen to the interest rate environment and growth rates go down, prices should fall. If growth prospects are unchanged, but the interest rate environment is going down, prices should rise, which has been a phenomenon that's been going on for the last 12 months. So while this is not a perfect model to use for valuing a company, and it leads to very large discrepancies, using it does provide some insight when you're trying to figure out, okay, what is the market response and why? Okay. Are there any questions? So today was a shorter class, but I think it was probably packed with a lot of information. And the quiz that's going to go along with this lecture is probably going to be more tricky for people. So do keep that in mind. I had a bit of a problem with the quiz that I posted. I put it on Canvas on Sunday, but for some reason had not set it up to be available. And so because of that, I have extended the quiz to midnight on Sunday, this coming Sunday. And I'm hopefully don't make that same mistake again this time. So you should get a quiz that you can actually spend time doing. But these are the techniques that lots of equity analysts use. And like I said earlier, most of them just stick to price to book, price to earnings. Sometimes price to sales, price to cash flows. So if there are no questions, all right, I will end class early. I will give you some time back.